Rich, from an allocator's perspective, 10-year Treasury yields are at 4.5%. What is going through your minds when you look at private credit? Are you looking at insurance as well? Yeah, tell us a little about how you're looking at things at Franklin Templeton.
So I'm just back from a week in the Middle East and attending the Future Investment Initiative conference, and the top 30 or so sovereign wealth fund and other investors there, just kind of quickly adding them up, represent more than 6 trillion AUM. I think Selection's already talked to the demand for private credit amongst insurers, which is very solid. But for many other types of investors and allocators, the demand for private credit is very strong, to the point where at that conference, anybody AI related was a rock star, but the private credit PMs were also rock stars, and they were very puzzled by that. One guy said,
"Oh yeah, they were.
I've been boring for 30 years, and now I feel like Brad Pitt at this conference." And if you look back the last 15 years, it's no surprise, private credit, 4 major flavors, 19 different sub-asset classes, has provided actual returns above equities with less observed volatility than bonds or cash. So the math has been too good to be true. We don't get to buy the past, we have to buy going forward, and yields have come in. But still, whether an investor is looking for return enhancement, diversification, inflation hedging that's not strictly CPI, but something broader and more real, different flavors of private credit offer different combination of those things. And I think it's a case of innovation in the real economy, innovation in the capital markets, rewarding investors that were willing to do something new, something without an established track record. If we go back 15 years, private credit was distressed debt and mezzanine lending. And those are still important sub-asset classes, but not the main show, not the most interesting show, and not the areas that have the highest yields. So I think allocator demand remains very strong, despite yields having come in as private credits become more acceptable to many types of investors.
And is there a specific type of private credit that you're more focused on the other than the other, or certain types of private credit you just won't look at? Or yeah, give us a little bit of a flavor of where do you kind of like to play?
It differs by client, but we see the biggest opportunities kind of in general in asset-based lending, asset-based finance, regulatory capital relief, anything to do with helping private equity investors get liquidity, which I think these guys have already spoken to, sort of areas of capital markets where banks have been pushed out by regulation and capital market participants really want to do something, and they're willing to pay something to somebody to get that done, not on their own balance sheet, but on somebody else's balance sheet. So there's plenty of demand for other types of private credit, but those are the areas where the math and the allocation models, you're getting the free ride of diversification benefit with return enhancement and volatility reduction at the total portfolio level. I think there's a lot of concern about where we'll see a bubble in private credit. Even if you look at the 2020 vintage year, when interest rates were zero and we were throwing helicopter money at the economy and just lending standards went out the window, and then 14 months later we had short-term interest rates of 5%. So think about that shock. We had a vintage year where we had the most liberal policies in the history in terms of monetary and fiscal authorities, and then we went to the most stringent, with 9.1% inflation, we went to the most stringent monetary conditions we've seen in recent history within the space of a year. We've only had about 1% of direct lending go to non-accrual in the subsequent 5 years. And that's on a yield premium that was started at 500 basis points and went up to 1,000 basis points. So even if all those loans turn out to be 100% loss, it's not a big haircut against the yield premiums that we got back then. That's a pretty big acid test for private credit, and yet we're not seeing signs of a bubble yet come through.